The information discussed in this presentation is current as of the date noted, is for informational purposes only, and does not intend to address the financial objectives, situation, or specific need of any individual investor. Any information is for illustrative purposes only and is not intended to serve as investment tax or legal advice, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Results will vary, and no suggestion is made about how any specific solution or strategy will perform in reality.
All right, well, thank you all for coming in. We got a pretty big crowd here, so I appreciate you taking the time out of your days to come and learn a little bit about taxes, how it relates to retirement. So what are we talking about today? So for better or for worse, it is taxes. You know, it's not everyone's favorite topic, but hopefully we'll be able to let you walk away with something that you learned today and hopefully answer your questions. And the reason why we're talking about taxes is because it's something that people often overlook. Over time, we usually see people come in and they're asking for advice. They're not really familiar with how taxes work and all the intricacies of planning that goes into it. And most people more commonly are looking at their investments and watching the markets, thinking about their own cash flow and their day-to-day needs and looking towards their retirement. But you don't usually think too much about taxes outside of just actually getting your tax return done and getting it out of the way. So it's something we like to focus on, as there's a lot of benefits in there if you kind of dive in and look into it, which is something that we try to do. And some of the things that we'll be talking about on how taxes can help you is, depending on how you plan for it, it changes how your retirement income will look like with the different ways that your income can be taxed. It can affect your Social Security benefits. It can have a large impact on Medicare premiums, which is something that probably a lot of people don't know about if you've never looked into it. And then taxes has a big plan in legacy planning, and where you leave your money and who you leave it to can make a big difference on the different accounts and where they go to. And as we go through the presentation, these are some of the common income streams that we'll be talking about. There might be stuff that we talk about that's not included, but the big things are Social Security, 401ks, and other retirement plans that you might have, and IRAs, pension income, your investment accounts, which would be like your brokerage accounts where all your stocks and bonds are, real estate income tied to like your house if you ever sell it, and something that we'll put a little bit more focus on near the end of the presentation is Roth IRAs, and a little bit more on how those work, because those can have a little bit more detail in them compared to like the normal traditional IRAs. And I'll pass it off to Jason to talk a little bit about the more recent tax law.
Okay, so what we need to start with is laying the foundation around taxes, because we know everyone may be on a different level of understanding on how taxes not only impact us day to day, but also in our retirement. Okay, so the first place I want to start is around, we got a big tax bill last year, if you remember, July 1 we got signed in the One Big Beautiful Bill Act. And when I first stepped back and look at it, and maybe you did the same thing, you said, well, geez, maybe not a whole lot changed, right? And if you actually do the analysis, and someone actually did this, roughly 60% of the tax bill was just saying, hey, keep everything where it is. Okay, so more than half. But there were some benefits baked in, but we don't want to just go pass by the fact that the extension of the regime we were living under did play a big role, or can play a big role, in our retirement planning and our retirement now, right? So the first one that I like to highlight is actually the tax brackets. We're gonna go through some of these in detail, but without this tax bill, the top tax bracket would have went from 37% to 39.6%, and that would have a trickle-down effect. So we would be paying higher taxes if this bill did not extend those tax rates. Now, I like to use the word extend because, and they like to use the word made permanent. And what I've come to learn over my years is nothing in the tax law is permanent. Okay, so just go into these extensions made permanent. No, they're really not. They can change those at any time. Okay, so we know we have current tax brackets for at least the next 3 years. We also got some additional tax relief for seniors. Remember, we're talking about taxes in retirement. Okay, so the main tax deduction, we'll get to some of the specifics, was addressing what the president said he wanted to do, was eliminate taxes on Social Security. We didn't get that, but we got something to provide some tax relief to those that are age 65 and older. We also got some expanded deduction opportunities. Now, we're going to get into that a little bit more detail as well. But it is one of the most frustrating parts of the tax law that changed during Trump's first administration. Gave us a little bit of relief, not everything we wanted, but it did get some expansion. And then we did get some changes around charitable giving, which we're into charitable giving strategies during retirement that may give us some positive impact against our retirement income. So let's go into this. Why is the tax rate so important? It's not just about the tax rates themselves, but some of the decisions and strategies we're going to talk about this evening, it would have made those strategies much more expensive. And while we as human beings, we don't like change traditionally, could you imagine if we as the advisors came to you and said, this is a great strategy, and we didn't have the extension of the lower tax rates? You might say, well, it's going to cost me more money now, so let's not do it, okay? Well, we only can deal with the law that we have in place today, and some of those strategies would still be fine if we didn't get these changes, but the tax rates kept intact things like Roth conversion planning that we're going to talk about and other long-term tax planning strategies. So this, we feel like this is not getting enough attention that we were able to preserve the lower tax rates that we have now, okay? Let's talk about this new senior deduction that we got. This is an enhanced deduction. This is the replacement for what Trump campaigned on, which was no taxes on Social Security. We didn't get that, but what we did get was a $6,000 deduction for anyone 65 and older, and it is per taxpayer on the tax return. So if $6,000 for one, if you're married filing joint, it's $12,000. Now there is an income limitation to this, okay? So you can have 6,000 come down to be 5,000 or 4,000. It could go all the way down to zero, but there is a big range there that you can operate within. And we actually had that impact on tax returns for 2025. So even though that tax bill and this new deduction didn't go into place until July 1, it applied for all of the 2025 tax year, okay? So we're already seeing some tax savings out of this. The question that we're going to answer tonight, though, through some of the strategies we're going to review, is do we just take that deduction and take the set tax savings today? Or do we utilize it to pay more taxes today to potentially pay less taxes later? And what I like to tell people is that taxes, a lot of times we're not getting the decision of whether we pay taxes or not, but we do have a decision of when we pay them. Okay, taxes are more of a timing decision than they are a decision of do we pay them or not. Okay, so keep that in mind. So we have this now in place, and that's going to be beneficial to us relative to age 65 and older. Go ahead, Abby. And then the expanded deduction, this was one of the more frustrating parts of the tax law change going way, way back during Trump's first administration. To give you the history lesson, if you don't remember, we used to be able to deduct just about all state and local taxes we paid. Remember that? There was no limitation. And living in the state of New York, if any of us are living in the state of New York, probably most of us are, that was even more frustrating because we live in one of the highest tax states in the country, okay? That goes for real estate taxes and income taxes. And that's what SALT refers to. SALT is the abbreviation for state and local tax, which covers state income taxes, local income taxes. If you're a PA resident, you pay local taxes probably. If you live in New York City, you pay local taxes. But it also refers to property taxes, so our real estate taxes, our school taxes, and so on. And way back when, it was very liberal deduction, okay? We got to deduct almost all those taxes that we paid. Then a tax law change went into effect that brought that deduction down to $10,000 capped, okay? And now we just got it expanded. We didn't get the full relief that we wanted, which was going all the way back to the old law, but now we can deduct up to $40,000, given, again, some income limitations, of those state and local taxes. So that certainly gives us a little more relief under this new tax bill that we can begin planning around. So what we've now just added is a senior deduction, a potentially higher deduction around SALT taxes. And again, I'll keep coming back to this, is do we use that to save taxes today? Or do we use it to bring in more income during our retirement to relieve ourselves of potentially higher taxes later? Okay. Alex, back to you.
Back to me. Now, if we take a step back from the recent law changes and stuff that's new in recent years, we kind of are going to go back to just kind of the basics of what income sources you have, what type of accounts you have, and how are they taxed. Most of this has been the same for quite a while. So we have three buckets. You have tax deferred, tax free, and taxable. You can go to the next slide. So the first one is tax deferred, or you can think of it as pay later. The common accounts here are like your traditional 401k or 403b or other retirement accounts, depending on where you work. Sometimes the letters and numbers change, but the accounts work similarly. Or another common one is the traditional IRA. These types of accounts you contribute to on a tax deferred basis, which means you don't pay tax on that money that you contribute this year. Then the money will grow tax-free for the duration that it sits in there before you take withdrawal. It means any interest and dividends on any stocks that you have in there, and if you're selling and trading stocks, nothing gets taxed like as that's going on. It's only when you make distributions later. And to that point, everything, because you didn't pay any taxes when you started and as it was going on, it means that you pay tax on everything that you take out after the fact. Once you get past retirement, you need to start taking money out. With a couple exceptions, everything gets taxed. And the key thing about these, and I'll apply to the next slide as well, is that a couple rules: you have to be 59 and a half years or older to not get a penalty on taking distributions. So that's the one caveat, that if you're putting money in, you have to be pretty sure that you're not going to need it for a while, so you don't want to pay that extra penalty. And there's a couple other rules, but we'll kind of get into that a little bit later as well. So you can go to the next slide. The next one is tax-free, and this is pretty much just the flip side of the last slide in those accounts, where instead of paying tax when you start and then paying tax and then, or instead of not paying tax when you start and paying tax later, you pay your tax now and you get tax-free withdrawals later on. And what the main ones of these are the Roth IRA and Roth 401ks have been a little bit newer in recent years. I don't remember exactly when those started, but those will function pretty much the same as the flip side of the traditional 401k and traditional IRAs. But how those work is you'll pay tax on those just the same as you would for your regular income if you weren't contributing it anywhere. But the benefit is that you put it into an account that will, just as before, grow tax-free, and you don't have to pay anything on it. But then the big difference is that when you take the money out later, it's all tax-free and you don't have to worry about it. Again, with the caveat, you have to be older than 59 and a half, and especially for Roth IRAs, there has to be a 5-year time lapse on it where the account needs to be open for that long. So if you opened it when you're younger, you're fine, but if you like go and open one today, then you just want to make sure that you give it 5 years before you can take money out without any penalties or anything. Other thing, the one note at the bottom is there's no RMDs on Roth IRAs. So going back to like traditional IRAs do have RMDs, something that we'll talk a little bit more in detail later on in the presentation. But RMDs are required minimum distributions where you're forced to take out a certain amount of money each year. Currently, once you reach the age of 73 for most people, that age keeps getting pushed up over time. And I think it's in like 2033, it's going up to like 75. So that age keeps going up. So that'll probably keep changing. But you're required by law to take that money out. For Roth IRAs, there's no requirement. You can just let that money sit in there and not touch it. That's something we usually recommend to clients, is that if you don't need to take money out of the Roth IRA, leave it as the last thing that you pull money out, with some exceptions depending on, it can have certain tax benefits, which we'll talk about a little. And so the other type of account, and one of the key differences in the taxable accounts, is with the tax deferred and the tax free, there's contribution limits on those accounts. So that's the main reason why you might think, well, why don't I just put all my money in those accounts that have all these tax benefits, is that the IRS and governments will limit how much money you can put in those. So once you max out your 401k and you max out your IRA, you're kind of limited to looking at other accounts. And one of the main ones that most people use is just a regular brokerage account. these accounts, you can put as much money as you want into those whenever you want. But there's no immediate or like end of the line tax benefit where you're not paying tax when you contribute or not paying tax when you withdraw. The main tax difference with these accounts is that they incur long-term capital gains most of the time. You can have short-term capital gains if you're selling stocks and not holding it for longer than a year. Those are taxed at ordinary income rates. But the tax benefit for brokerage accounts is that if you hold your investments for longer than a year, you get long-term capital gains rates, which are, for the most part, going to always be lower than your ordinary income tax rate. And we'll have some more slides and some graphs on what exactly those are later. But that's the tax benefit for these accounts. And the key thing for these is that as there's no tax benefits, there's no limits on when you can take your money out. These are your accounts, and similar to like a checking or a savings accounts, you can take your money out whenever you want for whatever purpose that you have. So there's no restrictions. So if you are someone who like retires early and you're like 55 and it's too early to take money out of IRAs and 401ks that you're taking from your employment, you can take money out of your brokerage account in the meantime and not have to worry about any penalties or any restrictions on that. And then a difference between these accounts and the IRAs and everything is that you incur interest and dividends and you pay tax as you sell stocks when you do it. So year over year, you'll have tax on any income earned in the account or any like sales and trades that you make. Those are all taxed each year. So you don't defer that until later.
Okay.
And back to Jason.
All right, so let's come back to the tax rates because Alex has highlighted a number of good things about the different sources of retirement income that we could see or utilize, right? So we've got those buckets, keep those in the back of our minds. We have tax now, that's your brokerage accounts. We have tax later, that's your tax deferred accounts. And we've got never taxed again, which is your Roth type accounts. So when we talk about what is taxed and how, we're talking about ordinary income tax, right? So we take distributions from our IRAs, our 401ks, our 403bs. These are taxable at ordinary income tax rates, okay? Those will range, and we'll get into the chart. Those are federal tax rates, 12, 22, 24. Well, they start at 10, 12, 22, 24, 32, and so on. And those we're gonna continue to pay in retirement, I'm sorry to say, okay? We're gonna pay federal income tax in retirement. If you didn't know that, I'm sorry to be the bearer of bad news, but it just is life, okay? However, the good news of all this is it's a progressive tax system, meaning that the first roughly chunk of money, $25,000 married filing joint, is taxed at 10%, okay? Then the next, I think it's roughly $25,000 or $50,000 is taxed at 12%, okay? So it's not, when your tax preparer or accountant says, well, you were in the 22% bracket this year, it doesn't mean all of your money was taxed at 22%. The first chunk is 10, the next chunk is 12, and so on. And this is taxable income. Okay, so how do we get to taxable income? Well, we add all our income minus our deductions equals our taxable income. And then we apply these rates to it, okay? It's not all bad news though, okay? Because as we work, we pay other taxes, right? We pay FICA at 6.2% on the first roughly $140,000 of income, and we pay Medicare 1.45% on all of our income. And guess what? In retirement, if we're not working, if we don't have a wage-based job, we don't pay those taxes anymore. So congratulations, you're avoiding some taxes, okay? Legally. Okay, so federal tax rates. Now, the things I like to point out here, because when we talk about, remember what I said earlier, is paying taxes isn't always a choice, but we do maybe get to choose the timing and how much, okay? That's the other, and that's why it's important to review our tax rates, because it's a marginal system. Like I said, if you're married filing joint, the first 25,000 is taxed at 10, the next 75,000 is at 12. But look at these tax rates. Look at where the biggest jumps are. We go from 10 to 12, that's not bad, it's not too painful. Then we go from 12 to 22. That's the biggest jump in the tax brackets, okay? We probably want to try to avoid that if we can, okay? Then we go 24, that's not too painful. Then we go from 24 to 32, ouch, there's another big one, okay? And then we go 35 and 37, okay? So there's planning in here that says, and reason, again, we're laying this base layer about what accounts are taxed and how incomes are taxed and so on, is because let's say we're in the 12% bracket. Let's say we have $97,000 of taxable income. That puts us really close up to the top of that bracket, right? And then, the car breaks down, we need to buy a new car. Where do we take the money from? If I take it from my 401k or my IRA, that's going to push a lot of that money into the 22% bracket. That's the biggest jump. Where else could we get it from? Well, we could take it from our brokerage account, okay? Because in our brokerage account, we've been paying taxes on the dividends and interest and capital gains all along. So just a withdrawal from that brokerage account doesn't cost us really any more money, ideally or theoretically, right? Where else could we get it from? Alex just said that we don't like taking from our Roths, but maybe there's some opportunities we would. Well, there's one right there. If I want to avoid an extra 10% on the next few dollars of income, maybe I want to use my Roth IRA in that example, okay? But let's say on the other hand, okay, we're maybe $50,000 of taxable income. And so we're squarely in the middle of that 12% bracket. And now the car breaks down. Would we use the Roth IRA? I sure wouldn't. I'm already in the 12% bracket. Would we use our brokerage account? Maybe. Would we use our IRA? And a lot of people would say, why the heck would I do that? I don't have to use it yet. But I would challenge you to say, why not? You're already in the 12% bracket. Why not pay more at the 12% bracket? Because we do know, like Alex just told us, at age 73, we're going to have to start taking that money out. And what if taking that money out pushes us up in the 22% bracket? Wouldn't I rather do a little extra proactive planning and take some out at 12 while I'm in the 12, in case later on I get pushed into the 22, okay? So that's why it's important to proactively plan through the brackets. What else do we get to play with? Well, like I just said, we get to subtract these things off of our income before it becomes taxable, okay? And we're going to get into some deduction planning here shortly, but these are the deductions we're handed. We already talked about the new enhanced age 65 bracket. There's $6,000, but that goes on top of a standard deduction of $32,200 if we're married filing joint. Okay, so we could be up to roughly $44,000 of deductions without even adding up mortgage interest or taxes or charity or anything like that. And we do know that if we go through the accounting and we add those up, and let's say it comes up to $32,201. Yeehaw, we itemized, right? By one whole dollar of benefit. That's all you get, okay? So why would we go through this exercise? Well, New Yorkers, pay attention. The New York standard deduction for a married filing joint is $16,000. So in all the efforts in prior tax bills to simplify our tax returns, we only just made it more complicated because if we live in the state of New York, we may not be able to itemize federally, but we might be able to on our New York return. So we still have to do all the accounting, okay? And it's all the same deductions, right? It's mortgage interest, it's taxes, it's charities, it's medical expenses potentially with some hurdles, okay? So this is why it's important to review those. And I'm going to leave with one comment after this slide. I want you to remember a silly phrase called lumpy deductions. Okay, we're gonna come back to lumpy deductions, okay? All right, moving on. Now, we just covered ordinary income tax. Now let's talk about what Alex told us about capital gains tax, long-term capital gains tax. It sounded like a great thing, and many of us know what that already is. Well, long-term capital gains taxes on the sale of appreciated securities that we have held for a year, we get a nice discount on that, okay? We don't have to pay our federal ordinary tax rate on that. And what a lot of people forget is qualified dividends. It's a special classification. Qualified dividends also qualify for these special discounted tax rates, okay? So this is why taking cash flow as we need it, potentially from our brokerage accounts, may make some sense instead of using 401k or IRAs, is because we know if we sell securities we held for a year, we get a nice discounted rate. How do we determine if we're in the 0% long-term capital gains or 15 or 20? And does it work like the ordinary income tax brackets? Well, no, you don't get the first chunk of capital gains at 0 and then the next chunk at 15. It's not the same thing, okay? But you will fall within one of these brackets. So let's review how we do that, okay? So these brackets, there's actually an overlap with the ordinary tax rates, okay? To keep it simple when we're working with clients, what we tell them is if you're in the 10 or 12% bracket, you're going to pay 0 on your long-term capital gains. Okay, so now you see why it's so important that if we can squeeze you into the 12, you can actually have a very beneficial federal tax situation. Pay 12% on your ordinary income, pay 0% on your long-term capital gains. Okay. Well, I'm going to pause on the 22% rate because you see it up there a couple of times. The next brackets of the 24 and 32, we're going to pay the 15%. We're used to that. Okay, that's usually what we're dialed into, the discount. And then the highest tax brackets, we're going to pay 20% on long-term capital gains. What do these numbers mean in parentheses underneath? Well, those are the ordinary income tax rates. And you see 22 in both places and you see 35 in both places. That's because the bright federal accountant that designed this overlapped it just to make it simple on us, okay? So in our planning, it's, well, I'm in the 22%. Am I in the 0% long-term capital gains or am I in the 15? I don't know. I got to see your tax return. We got to figure this out, okay? So there's some intricate planning there, but just know that there is a discount, and that should become a factor when we're in retirement. We're trying to find the right cash flow mix to fund whatever we need to fund. That long-term capital gains tax does play a significant role.
The next thing we have here to talk about, which is pretty straightforward, is capital gains on the sale of your home if you ever sell it. So something that a lot of retirees end up doing once they retire is thinking about either downsizing or moving somewhere else. A lot of reasons: you're no longer tied to your job, so you're free to move if you want. You probably, if you had kids, they're probably out of the house now, so you don't have to worry about them anymore. So you have the freedom to kind of do what you want and move somewhere if you need to. And the good thing about selling your primary house is that there's a big exclusion there from capital gains. If you live there for 2 out of the last 5 years, and you own the home for the last 2 out of the 5 years. It's usually the case for your, the main home that you're living in. It's basically $250,000 per person. So $250,000 if you're single. Any gain on the house sale will not be taxed, and if you're married, $500,000 will not be taxed. So if you bought the house and the total cost basis was $500,000 and you sell it for $1 million, you don't pay any tax on that. But if you sold it for $1,250,000, then you're paying tax on that extra $250,000. So that's kind of the main tax benefit for selling your house, that you can kind of keep that in mind, that there's that big chunk that you get some extra money back when you sell to either put towards the next house that you're buying, or if you needed it for cash flow reasons, that can put some money back into your savings to help fund, whatever your plans are for retirement. Next thing we have here is a couple of details just on a couple particular rules for New York and Pennsylvania, since, like Jason said, we assume most of you live in New York or Pennsylvania. If you lived in a different state, I don't know why you're here. I don't know why you drove all that way, but that's up to you. So for New York, is similar to the federal return in that they have a progressive tax system. The lowest rate is somewhere in the 4% range, and the top rates get to around 8%. So lower than federal, but you still get to pay more tax if you earn more money. The couple details on what is excluded from New York State income, which differs from other states as they all have their own rules, is New York State pensions, which we see most commonly with anyone who works as like a teacher, often has a state pension, and New York will not tax any money on that. So that's a big chunk of your money that, while it's taxed federally, you get that tax break on the New York return. And then aside from any pensions that are fully excluded, each taxpayer gets $20,000 from any other retirement income that is not taxed. So if you and your spouse both take out 20 grand from your traditional IRAs for the year, each of those $20,000 chunks are not taxed for either of you on the New York State return. And as that's per person, if only one of you has an IRA and you had to take $40,000 out, it's just yours, then only $20,000 is excluded, the other 20,000 is still taxed. And the other big thing is Social Security is not taxed, because that's not the case for every state. I think majority of them don't tax Social Security, but there are some states out there that will. But thankfully, that's at least one thing that New York doesn't tax. For Pennsylvania, they're a little bit different. They have a flat income tax rate. It's about 3.07%. So you kind of have a pretty guaranteed idea of exactly what you are paying if you're retired there. And the key difference between Pennsylvania is they're a lot more lenient on what they exclude when it comes to retirement income. They just don't tax on IRA withdrawals and 401ks, which more or less the same thing. Usually when people, leave their job, they'll roll their 401k into their IRA. So it usually ends up getting consolidated anyways. And then just pension income in general. It's a little bit different than New York, where they specify only New York state-based pensions. If you work for the state, Pennsylvania is more generous there. And it's not on the slide, but PA also doesn't tax Social Security.
Okay, let's talk Social Security. What is beyond the scope of this session is when to take Social Security, at least the standard questioning that we get, right? Because we tend to think of that decision around, do I take it at 62? Do I take it at 67 or whatever full retirement age is? Do I take it at 70? That's beyond tonight. But what does play a role in that conversation, but usually doesn't come up, at least it's not top of mind, is the taxes on Social Security. Social Security is a pretty tax efficient stream of income, and we need to kind of keep that in the back of our minds when we're wondering, where do I pull cash flow from? See, one of the things I tell clients is the investment thesis needs to come first and taxes come second. But tonight we're talking about taxes, okay? And if we think about Social Security from a claiming strategy of when to take it, of when we get the most out of it, that's an investment thesis in a way, right? Because it's, if we leave it there, we get 8% per year gain on that, okay? But from a taxation standpoint, we might think of it a little bit differently. Social Security is a pretty tax efficient stream of income. Like Alex just said, most states, I think all but 7, it is tax free. Okay? So we know that's a source of income we can pull from and pay 0 state tax on it. Up to 85% of it is taxable on our federal return though, but there's 15% that's not, okay? And that's scaled by income. Now, when the Social Security program was first started, you may not know this, it was rolled out as a tax-free stream of retirement income, and that went away real quick. So now up to 85%, okay? So taxes does need to play a role, because if we're in a situation, let's say in our early retirement years, let's say we have this stream of payments that's still coming to us from an employer, or maybe it's an annuity that's starting to pay out, which is putting us in a higher income bracket, and we need cash flow. Again, where do we go back to our buckets? Do we take it from our tax deferred accounts and force us into a higher bracket even? Do we take it from our Roth, which we really don't like doing if we don't have to? We like, how many times are we gonna get something tax-free? So we like to leave the tax-free stuff right where it is if we can. We could take it from our brokerage account. Okay, remember we said we're always paying tax on that anyway, but maybe there's some big built up capital gains that we're not ready to take in this year because our income's higher. And so instead of paying 0 or 15%, we're gonna pay 20% long-term capital gains, right? So Social Security could be a source of income that is fairly tax efficient. And people would say, well, but wait a minute, because everything I hear and read says I should wait to age 70, okay? And I'm not denying the fact that we are programmed to wait until age 70 to take our Social Security. And that's because the math will always work to delay it as long as possible if we think we're gonna live to about age 80, okay? That's the crossover point. If we wait till 70 and we can live to age 80, that means that we will have duped the system, we'll have collected the highest amount, okay? But if we take it at 62, okay, we're taught that we're already accepting the discount, okay? But we're accepting the discount, but did we factor in the tax savings relative to other sources of income that would help offset that discount, okay? And then there's other factors. Do you believe Social Security will be around? What's your health like? What's the rest of your balance sheet look like? But we just don't want to put this aside because we're always programmed in that the math says wait as long as possible, okay? Because it is a fairly efficient stream of income. What other streams of income do we have to worry about? Well, as Alex said, at 73, we got to start taking distributions from somewhere, from our tax deferred accounts, from our 401ks, from our IRAs, from our SEP IRAs, and so on. Now that age in 2035 is going to go to age 75. So if you have already turned 73 before 2035, you're going to stay in RMD. You're going to have to keep taking those, okay? If you turn 75 in 2035 or later, that's then when you get the delay. Why do they keep changing this? Does anyone remember what it used to be before all of this mess? What was the original required distribution age for a long time? 70 and a half. Does anyone remember that number? Do you know why they started changing it? To solve the retirement savings crisis. Do you know why that's a hoax? Because you can still access your money at 59 and a half. They haven't changed that age. If they want to shut people down from taking money out early because they haven't saved enough, you play with that age, not the age at which you're forced to take it out. A little bit backwards. But that's okay. We'll work with it because guess what? We're not forced into taking anything until this age, okay? Remember, we have the choice though. Taxes are a timing decision, not necessarily are we going to pay the tax decision. So if you run the math, how does the math really work on your required distribution? When in the year that we turn whatever age it's going to be, okay, we take the year-end value of our account. Okay, let's say with the example here, we have $1 million. $1 million in our IRA, and let's say we turn 73 today. Okay, so we 12/31/25, we had $1 million. Then there's a formula, and that formula has a variable in it that changes every year we get older. Okay, the variable the year that we turn required distribution age is 26.4. That's the factor. If you turn that into a percentage, it's 3.65%. So you have to take 3.65% roughly of your $1 million when you turn 73, okay? With one exception. There's always an exception, isn't there? One exception. In the first year of our required distribution, we get to delay that if we would like to April of the following year. We don't have to take it in this tax year. So if we turn 73 today, we can take our first required distribution in January, February, March, or April of next year, okay? What problem could that cause? Do you get to delay next year's? No. You would then have to double up. So some people are dialed into this deferment. Well, if I don't have to take it this year, let's defer it to next year. Well, then you got to take two. Now let's go back to the tax rates and figure that out, okay? So that's how the math works, and that variable changes every year. So 26.4 becomes, I don't know, something different than that. So 3.65%, the point is that it grows, the percentage grows, because as we get older, we're going to live as long and they want us to take out more and more every year, okay? What can this affect? If we're not doing proactive planning on our RMDs before we hit 73, we could be forced into higher tax brackets. Our Social Security could be more taxed, okay? Remember, up to 85%. Medicare premiums. We get to fall in love with that lady named Irma.
Yeah.
She's not so fun.
No. To speak of the devil, Medicare premiums. So what we kind of mentioned before, and as Jason was just leading into, is that once you turn 65, everyone kind of ends up going on Medicare for the most part. And when you do that, there's two things. Medicare Part B and Medicare Part D have premiums attached to them. Part B, everyone is forced to pay a minimum amount, which is currently like a little over $200. I forget exactly what it is. And that goes up every year. And then Part D is the drug plan that goes along with, and that has its own premium attached to it. So those start at like a fixed amount for everyone, that everyone has to pay at least that much each year. How those change is depending on your income. And it's not going to be on the slides, but it is in the booklet that we gave out to you. There's brackets on exactly what those IRMA brackets are. And IRMA stands for Income Related Monthly Adjustment Amount. And what it is that if you reach a certain level of income for the year, your Medicare Part B and Part D premiums will increase to a higher level. And unlike the federal tax system where it's progressive, this is just the next level is a flat increase. So if you're even $1 over the next limit, you're paying the next level of IRMA premium amounts. So that's a big part of planning, where we look into managing how much taxable income our clients have for the year, is making sure that they're not unnecessarily crossing into the next IRMA bracket, so that they're not paying extra premiums on Medicare if they can avoid it. Sometimes if you have a lot of money and you earn a lot in the year, You just kind of have to deal with it. And, at the end of the day, it's a benefit. If you're earning more and you have to pay more, it's better to earn more money on the front end and pay more in Medicare premiums. But if we can avoid it, that's best too. Um, and so that kind of goes back into like, where do we take money from? The traditional IRA, brokerage accounts, Roth IRAs. If we can play around with those different buckets and you have the flexibility to take money from different places, it lets you like have the options to take, tax-free money when you need it to not kind of push yourself into these next income brackets. The next big thing, and how I mentioned towards the beginning, where we're going to talk a little bit more about Roth IRAs. That's because a lot of people have probably heard the term conversions mentioned. So what are these? So something you can do with your traditional IRA is convert either a partial amount of that money or all of it if you wanted to into a Roth IRA. And when you do that, because you didn't pay tax on the traditional IRA at the start, if you're converting money from your traditional to your Roth IRA, you'll have to pay tax on that converted amount. And that will obviously increase your taxable income for the year. And when we look back at what Jason talked about earlier with the federal income brackets, if you're at like 50,000 and you're halfway in that 12% tax bracket and you have that leeway to take more taxable income for the year, it could be a benefit to you to think about a Roth conversion and kind of fill up the rest of that bracket while you can, to only pay 12% on it and not go any above so that you're paying 22% on it. So if you kind of have those leeways in those tax brackets to make conversions, it can be good to convert some money year over year if you have that leeway. And the reason why you would want to do this is, going back to the Roth IRA, is that now you'll have tax-free withdrawals going forward. There's no required minimum distributions. And because the money is tax-free, there's more flexibility on taking that money out, because there's generally not going to be any tax like restrictions or any like tax burden to consider as you're taking the Roth IRA money out. So it's good to plan ahead and take money out of the traditional IRA when you can, when it's making the most tax benefit for you year over year, and get that money into the Roth IRA. That should be good. A couple more things on the Roth conversion is, and I already kind of talked a little bit about this, is kind of looking ahead at projected RMD amounts and how much money you're going to need to take out in the future. Again, if you're over 59.5 and before, you're starting to require to take money out. As you have that leeway, being able to take money out early will reduce the RMDs later, which again will help keep you from pushing yourself into higher tax brackets depending on how much your RMD is. So we can't stop taking the RMD once they started, but if we can lower the total balance of the traditional IRA before you're required, that can help you out in the future when we're able to plan more early on. And then when you're thinking about your retirement accounts and looking to the future of where you want to take your money out, again, a Roth IRA is just more flexible because you don't have to think about your taxable income and worrying about how much tax that you need to pay. When you take money out of a traditional IRA, you have to think about paying your federal income tax and your state tax. And usually when we end up doing that, it kind of gets into like a weird balancing act of like, okay, I need to take 40,000 out of my traditional IRA, but that means I need to pay tax. So now you need to take more than 40,000, because if you only take 40, you're only getting, say, like 30,000 after tax. There's a weird game of actually planning for how much money you actually need to take out for the money that you need. But for a Roth IRA, you don't really have to think about that. And then tax rate optimization is kind of what I was talking about. That if you can pay taxes now when you're in lower income tax rates, spreading that out over time is better than if you need to take a large distribution in 1 year. That's going to push you into higher tax brackets. So planning ahead kind of avoids that scenario where you have like that tax-free bucket to take money from if you need it. And then there'll be some other slides talking about gifting these accounts to beneficiaries as well, but a Roth IRA is a good account to leave to your kids because it is tax-free. They don't have to worry about paying any taxes on that account and that money that you're giving to them. We'll get a little bit more into that in future slides as well.
All right, I said we would be coming back to charitable strategies in retirement. So this, now you're getting the sense of we've covered our basis, we're getting into strategy work here, and we're going to start pulling a lot of these things together, not just specifically bucket by bucket, but we're going to commingle a lot of these things, okay? So we got to cover charitable strategies first. One of the great things that happened in the tax code a few years ago was something called the QCD, if you've ever heard that acronym, or it's also known as a qualified charitable distribution. What this allows us to do in quote unquote retirement, it actually starts at 70 and a half. We can't do it before, but at 70 and a half, we can take money from our IRA and give it directly to charity, okay? So we're gonna cover all the reasons why we would wanna do that, pros, cons, and so on. But it is a direct gift from an IRA to a charity. So what am I not saying? Can we take it from our 401k and give it to a charity? No. So this is one of the reasons why we often recommend that people roll over 401ks to IRAs. There's many reasons why it can be beneficial. This can be one of them. You can't do it from a 401k. You can do it from an IRA, okay? Goes directly to a charity. Do not pass go, do not collect $200, and so on. What that means is, if it comes out of our IRA, normally we have to do what? Put it on our tax return, claim it as income, right? But if it goes directly to the charity and doesn't go into our pocket first, guess what we don't have to do? We don't have to claim it as income. Now, the common question we get is, do I still get the tax deduction? Do I still get to put it on my Schedule A of my taxes? And the answer is no. But do you really care anymore, right? The whole point, or one of the key tax strategy points of this, is that I'm going to give money to charity because I want to give to charity, but also I get to take a potential deduction on my tax return. Well, if I don't have to claim it on my income tax to begin with when it comes out and it goes right to the charity, well, that makes a lot of sense. I'm okay with that. Guess what else this does? Remember Alex mentioned that Irma lady we don't like? All right, so now this is a way to reduce income, get the tax benefit from the charity, not on the normal way we do it on our tax return, but we get to do that. We've reduced our income, we avoid Irma, we potentially reduce the tax exposure on our Social Security when we're claiming that, because we would have claimed it by now. Remember, we can't do this till 70 and a half. We wouldn't wait till after 70 to claim Social Security, or we'd wait up to 70, okay? So this is, if you're charitably inclined, this is a really great way that has a lot of tentacles into tax savings, okay? The key things, again, I'll repeat them again, has to come from an IRA, okay? Has to go directly to the charity. You have to be 70 and a half, okay? So this is a good way to reduce your required distributions. Remember, we don't have to start taking required distributions till 73 now. And Alex just talked about tax optimization and reducing what our RMDs could be. This is a way to do it. From 70 and a half to 73, we can load up our charity, okay, and give it from our IRA. But we can also do it after that fact too. We can actually go up to $111,000 a year. Even if our RMD, let's say our required distribution is only 40,000, you can still go to 111,000. So you've eliminated your whole required distribution and then some, okay? So there's a lot of great tentacles to this charitable strategy. Let's hit some more. Okay, there doesn't look like a lot on here, but I'm going to spend a lot of time on this slide because there's some big ones, okay? For a long, long time, we've been able to give away appreciated stock to charities. But up until maybe 10 or 20 years ago, charities really didn't know how to handle that. But most charities today do. And most of them have brokerage accounts. They do receive shares of stock, okay? So with the price of Corning, we all know we're in the area enough, we know Corning stock is doing really well these days. I could take a couple shares of Corning stock and I can transfer it right over to the charitable organization, okay? And what does that get me? Well, if I give a check for $1,000 to a charity, I get a tax deduction potentially on my Schedule A, right? That's a benefit. I could do that with stock. Give them $1,000 worth of stock, and I get the same tax deduction. But guess what else I get? This is a potential double benefit tax strategy. If I had to create $1,000 in cash to give to a charity, I'd sell my stock, I'd pay capital gains tax, I give $1,000, well, I don't have $1,000 anymore. Alex just said I have to factor that in. So now maybe I've got $750. So I paid long-term capital gains tax. I gave the cash to charity and they only got $750 and I sold $1,000 worth of stock. The double benefit here is this. I give the stock and I still get that tax deduction, but I also avoided the capital gains tax because charities receive the stock and they don't pay tax. So I get the full $1,000 of benefit, even if I only paid $250 for it. I get the $1,000 of potential tax deduction, and I didn't have to sell it and pay the capital gains tax on $750. Everyone okay with that? I like it. What else can we do? Something that we've been talking to clients a lot about is called donor advised funds. And what these are, there's a little bit of the instruction in the name, donor advised, okay? This is a fund that allows me to put money into it, make my gift, therefore I'm the donor, and then when the money's there, I can advise them on how to pay it out, including when, okay? Why the heck would we do this? Why wouldn't I just take the money and give it directly to charity? Well, we're gonna overlap some strategies, so try to follow along, raise your hands if you have questions if I'm going too fast. It all boils down to that phrase I gave you earlier, lumpy deductions, okay? Well, let's say that in a normal year, I'm pretty charitably inclined, but my deductions, they just don't get over that $32,000 mark we talked about earlier, okay? But I'm still gonna give to charity. How can I, in retirement, get a better tax impact for my charitable wishes, okay? Well, we talked about one, QCDs. This one where we combine a bunch of things, okay? I can actually take a big chunk of dough. Let's say I give $10,000 to charity every year. If I'm not getting over that $32,000 mark, I'm really not getting any tax benefit for it. But what if I had a place where I could take $50,000, 5 years worth of giving, and put it in there and get the tax deduction and just store it there until I'm ready for the charities to get it? And therein lies the donor advised fund. These are managed by large institutions like Fidelity, Vanguard, Morgan Stanley, Charles Schwab. And what they allow us to do is put a big chunk of money in, say $50,000 in my example. I get my charitable deduction in that year, okay? But then as the advisor to the fund, I get to log into my account and tell them where to send it and when to send it. And there's no end date, except obviously my death, okay? So I could spread it out, $10,000 every year to charity, but I got my $50,000 deduction in the year I put the money in. That's a completed gift. I can't get it back. It is a charitable contribution at that time, okay? That sounds pretty good. I could write a check and get it in there today. Let's add another benefit into this. I've been fortunate enough to invest well, and I've got $50,000 of stock with $40,000 of capital gain. I could sell the $50,000 of stock, pay the capital gains tax on the $40,000, and put the money in the donor advised fund. Or I could do what? I could put the stock in the fund and avoid the capital gains tax and take a deduction for $50,000 when I normally wouldn't get any deduction. And I could get above that standard deduction amount this year. And then the rest of the time, I just fall right back into the standard deduction mode, which is okay because that's normally where I am anyway. And that's the lumpy deduction strategy, where you lump your deductions together, block them into 1 year, and at least get some benefit from them when you can, okay? Now, what else could we possibly do? We've got a higher standard deduction. We've got a senior deduction. We're charitably inclined, and we put a big chunk of dough in a donor advised fund. The question for you will be, do I just take advantage of lower taxes that year? Or do I use all of those deductions to incur more income at a lower tax bracket, potentially avoiding higher income tax in later years? And that's the mystery to solve.
The next thing here is how retirement accounts are inherited and the differences between them and like who you want to leave them to. So there were some recent tax law changes, and there used to be a big difference between traditional and Roth IRAs where traditional IRAs, if they're inherited to like a kid or a grandkid, there was and still is a 10-year rule where all of the money in that IRA needs to be withdrawn within 10 years. And for traditional IRAs, if the person who died was taking RMDs, then the kid or whoever the beneficiary is will also have RMDs based on their age. But regardless of the RMDs, by the end of the 10 years, all of the money has to be taken out. It used to be that for Roth IRAs that they didn't have that 10-year rule, but recently now they have the same rule. The only difference is that they also still have no RMDs, so that the beneficiary is not forced to take any money out year over year, so they can keep the money in the Roth IRA for the full 10 years if they want, because again, it won't be taxed as it sits in there. So it's a good spot to leave it if there's not any other need for that money. But then just like the traditional IRA, after that 10-year mark is up, they have to take that money out. And unfortunately, they cannot roll that money into like their own Roth IRA. They just have to take the money out and put it somewhere new, whether it's like a brokerage account or that they want to go out and spend it maybe recklessly on like a big house or something. That's up to them. But one way or the other, that money has to get taken out of those accounts. So for the traditional IRA, something to keep in mind is that if you're leaving that to your kids, that they will have a tax burden on that money, whether it's right away and they're taking money out year over year, which is usually better to spread it out over the full 10 years instead of waiting to take it all out in 1 year. That's something that they'll have to keep in mind and be aware of, that they will have to pay tax on that money. And then some of the options for who you leave which account to, as Jason was kind of talking about QCDs, leaving a traditional IRA or a tax-deferred retirement account to charity can be a good idea, depending on how much money is in the account and how much money you're looking to leave to charity. Just with QCDs and leaving those distributions to them, the charity won't have to pay tax on that money, so you can have a tax efficient benefit of donating your money to charity by avoiding any tax on that distribution. And if you're looking to split your money like in like 2 different directions, it's good to leave Roth IRAs to your kids or grandkids, as I just mentioned, where those don't have any tax burden. Even though they do have to be distributed now, at least the kids won't have to worry about how much tax they have to pay. So if you're split between giving money to charity through your accounts, better to use the traditional IRA for charity and the Roth IRA for your actual beneficiaries. And then for your taxable brokerage accounts, the good thing about those is that when you die, the beneficiary will take a step up in basis on the value for the account. So if you had stock in there that had appreciated over time, it's good to kind of, depending on the stock, you don't want to just leave stock in there forever, because anything can happen to a company. But if you have a highly appreciated stock and you're 100 years old, maybe you just want to hold on to that, because when your kid gets that stock, their cost basis will now be the value of the stock when they inherit it. So they'll have a new cost basis starting at whatever that value is, and you kind of avoid capital gains tax on any growth in those stocks.
Okay, coming back to our strategies a little bit, and some of the common oversights that we see, and we've highlighted a bunch of these. So I just wanted somewhat of a wrap up, but mentioning a few different things, right? So obviously, with all of the things we've learned tonight, that trying to pre-plan and avoid major withdrawals from tax-deferred accounts is sort of should be a big flashing sign on your radar in retirement, right? It may make sense in some years, right? Years where you've implemented the lumpy deduction strategy. These are good years to take big withdrawals, okay? Use the deductions in that year. Don't just take the lower tax rate, use it to be able to take more out of your tax deferred and either convert it to a Roth or fund whatever project that may be coming down the line. Don't give up these years that you may have lower tax brackets, is what we're saying, okay? You want to avoid big withdrawals when you need it last minute, because inflated tax rates, IRMA could be an issue, right? So we want to avoid those potential issues. Waiting until RMD age to plan around withdrawals. Like we've hit on a number of things with that, right? There are opportunities if you think, well, if I retire at 60, and a lot of the things that Alex said, I have from 60 to 65 when I jump on Medicare to avoid, I don't have to worry about IRMA. So I've got a lot of planning. I got 5 years of planning where I can take monies out of my tax deferred, which will do a few things. I can put it into tax-free growth mode, into a Roth IRA. I can put it into a brokerage account, okay? I'm avoiding IRMA because I'm not even on Medicare yet. And I'm reducing future RMDs potentially that may push me into IRMA and higher brackets. Then from 65 to 70, yes, I have to plan around IRMA, but at least now I've got 5 more years, actually 8 more years before 73, that I can continue to plan around tax brackets, but I also have to factor in IRMA, okay? And what are the, in structuring kind of the strategy around what Alex just said in terms of what are good accounts to inherit, right? When we think about Roth IRAs and leaving them to kids and grandkids, okay, those are ways to create a legacy in our estate plan and give a gift now without handing a check. I mean, how many of us, you don't have to raise your hands, but how many of us would be a little hesitant to give kids money right now, or a big chunk of money? Maybe some of us, okay? But we can create a legacy that says, I'm going to prepay the tax on money I know I'm probably not going to spend in my IRA or my 401k. I'm going to create this tax-free legacy for you, son, daughter, grandson, granddaughter, by converting monies when it makes sense for me, putting it over into a Roth IRA. I've paid the tax for you. You're not going to get it till I die, but then I'm leaving you this tax-free legacy, okay? So there are ways that it may make sense, but certainly don't wait until RMD age to start planning these things. Not coordinating Social Security timing, we've talked about that already, relative to taxes, triggering higher Medicare premiums through IRMA, and just ignoring those tax diversification opportunities in general. We are so programmed to avoid taxes today, we need to start reprogramming our brains that maybe avoiding taxes later is actually going to save us more money, okay? A couple of additional considerations. If we're not retired yet, Roth 401k versus a pre-tax 401k, you can apply that to IRAs as well. We are normally thinking that, well, in our lower income years, we want to be funding our Roth 401ks. And in our higher income earning years, we want to be funding our pre-tax 401ks. That still holds true generally, okay? But we also want to look at where we stand today relative to required distributions, right? Because every dollar we're putting into tax deferred monies has to come out at some point in time. So it's not just a standard way of thinking. If I'm in a high bracket, I should put it on pre-tax. That is, in fact, still probably 60, 70, 80% of the time true. But don't forget the fact that by putting into a Roth 401k, yes, we're paying tax now, right? We're making that choice, but we're avoiding potentially higher tax rates down the road. Another one, if you have company stock, I'll cover this one. This is a somewhat complex topic. If you have company stock inside your 401k and you say, it's a great time to sell, do not make that decision right away in your 401k, okay? There is a planning opportunity called net unrealized appreciation. It is a tax favored opportunity that you get when you retire. You have to roll your 401k out, but if you have company stock in there, you can extract the company stock, pay tax only on the basis of the company stock, and the rest of the gain, you get to pay long-term capital gains tax on it, okay? So all that, it is complex, it's specialized, it's customized to each and every one of you. Hit the pause button before you just automatically sell company stock in your 401k. Talk to a tax advisor about this, or a financial advisor, okay? We get the question, because retirement has changed, maybe not for some of us, but the younger generation of retirees, I'm not just gonna sit around and do nothing, right? That's what we often hear. I'm gonna work. I'm gonna do something where I don't have to take work home, I don't have to work 40 hours a week, I don't have to, work in the same location, or I don't have to work as many hours. We get the question, should I contribute to a retirement plan? Sure. I mean, the same standards apply here, right? Am I going to get a company match? That's free money. Let's do it, okay? Am I in a lower bracket? If I'm in a lower bracket, maybe I start building the Roth version of the 401k now, right? Like we just said earlier, okay? So the answer can be, and probably is, yes, should you contribute to retirement accounts, even if you're in that post first career job in retirement.
Well, now we've kind of talked your ears off for however long we've been talking. So to try and wrap up a little bit of what we talked about and like what you should take away. Again, as we kind of mentioned a few times, and generally speaking, is just planning ahead about when you're paying taxes and kind of where you're taking your money from and how that impacts your income and the various like deductions and taxes involved. So that kind of goes back to looking at your tax deferred accounts where you have to pay tax on, your brokerage accounts where you're paying your capital gains tax on, and then the Roth accounts where you don't have to pay any tax on. Having those different buckets to kind of pull money from to manage how much tax you're paying and when you're paying it. Again, having the different buckets built allows you flexibility so that if you need to pull money, as Jason's car example, you need to buy a car. If you have that Roth IRA to pull the money out from, that can be very helpful versus where if you only had a traditional IRA, you're just kind of forced to take money from that. That could be more of a burden when you don't have any choices. So it helps to have the different buckets to allow for more planning options. And then just generally speaking, just tax planning in general, it's just helpful to know what to expect down the line so that you're not surprised about certain ages, like how we talked about with the IRMA, that you're not surprised that once you turn 65, you're expecting to pay X amount of money for Medicare, but then you find out they're actually paying double because you're earning more money than the base amount for that. Or once you get to age 73 or possibly 75, and you have RMDs, just kind of being aware of these different uh, things that you're like forced into when it comes to retirement accounts and tax planning. Just being aware of these ahead of time is helpful because as it comes to RMDs, once you get there, you're kind of out of options. You have to take it, but if you're aware of it ahead of time, you can start taking money out once you turn age 59 and a half. You can kind of plan around that ahead of time while you have that leeway there. And pretty much just all of this just helps support your financial goals for the long term. That as you're doing all this planning, if you're saving on taxes, it just helps in the long run that you're not paying more than you need to year over year. And you're kind of taking advantage of the various deductions and income limits and everything that's out there. Just being aware of all those helps in the long term.
Thanks for watching. If you found this video helpful, give it a thumbs up and hit that subscribe button so you don't miss future updates. Looking for more insights like this? Head over to our website at jgua.com for additional resources. And if you'd like to talk about your personal financial goals, we'd love to help. Just click the Schedule a Meeting button highlighted on your screen to book your complimentary consultation. Thanks again for joining us. We'll see you in the next video.